Welcome. I get to sit this year. We're going to save this seat for Brian Kim. He should be here momentarily. Welcome. Thanks for coming. I'm going to thank the guys for being here. I appreciate it. I love talking to them at any time. Hopefully you guys can hear a little bit about what's in their head, how they see the world. Some of the sharpest guys in the industry doing some of the biggest deals today. So I always want to hear what they're doing, see what trickles down to the rest of us. I'll ask you guys to start out by introducing yourself, if you can. I'll let you guys give a quick seconds on who you are.
Sure. Cyril Shah, I'm with Starwood Capital Group. I head up our U.S. hotel acquisitions and hotel asset management platform. We have about $10 billion of hotel assets in the United States right now.
I'm Tyler Morse, the CEO and managing partner of MCR Development. We have 90 hotels in 23 states, roughly $2 billion portfolio.
Mitch Shaw, CEO of Noble Investment Group. We've got $2 billion of assets under management. We started as an owner-operator about 23 years ago here in Atlanta.
10 billion, 2 billion. There's a lot of capital up on stage. So I want to get where you guys' head are, right? Obviously, we're going to talk about state of the industry. Before we go there, I want to go backwards. Let me set the stage, if I can, for you guys. My interpretation of 2016, right? So 2014, 2015, Cyril, Tyler, you guys had tons of capital just jumping into the industry. You spent $2 billion, $10 billion buying limited service hotels. In end of 2015, that seemed to have stopped. So 2016 seemed to be pretty slow from a transactions volume standpoint. Agree, disagree?
Go ahead.
Yeah.
Agreed. 2016 was a kind of a wasteland from a transaction standpoint. I think transaction volume was down 50%. To 2015. I think declining RevPAR was a factor in that. And there was, frankly, just a huge bid-ask spread. Sellers still thought it was 2015, and buyers were watching Wall Street announce 1% to 2% RevPAR growth, and the lines never crossed.
Yeah, I would say I think 2016 got started off really poorly in January. And in, I guess, December of 15 and into January, you saw the REITs crumble almost 30%. And I think that put a whole chill on kind of where everyone's thinking, we're 7 years into this cycle. Is this kind of the time, people are forecasting potentially negative RevPAR growth, or they were thinking it was happening. A typically strong market like New York was looking like it was getting weaker and weaker. And I think, as you said, the bid-ask spread really kind of started off 2016 kind of very frigid.
So how many assets did you guys buy in 2016?
I think we bought about $450 million of assets in
2016.
2016. And in 2015, I think we bought about $1.5 billion.
About 2014?
About $1 billion.
Okay.
So we made about almost $2 billion in 2015. So
Tyler, how about you guys? Transaction volume.
2014 was a big year. It was probably $600 million. 2015 was probably $400 million, and then 2016 we bought 2 hotels. Way off.
So we all know from stats, industry was off 40% transaction volume last year, roughly. I think I'd like to blame them.
Well, look, I think you can, but the reality is, and again, what Cyril said, when there's not clarity about what's going on in the market, and this time last year, as all the public companies are putting out their earnings estimates and the RevPAR growth, everyone's saying it's going to be 2, 3, 4%, et cetera. And then quarter over quarter, everyone's reducing the estimates, and no one has any clarity of what's going on. And quite honestly, prior to the election, we all kind of felt that we were going to be in a situation this year at this time where there would be more clarity, and there's actually even less clarity that exists today. And I think we can all kind of look at all of our P&Ls. And Florida's a great example. Tampa had an unbelievable first 2 months of the year. The rest of the state was a bloodbath in terms of what was going on. And there's no real rhyme or reason of what's happening. And there still is no lack of clarity. So if there's no lack of clarity, and when you come out and say, hey, listen, here's a group of assets that's for sale. Here's what the pricing is. That pricing is optimistic from a seller standpoint because we're all sellers. And it's met with some trepidation from a buyer standpoint because the reality is that none of us know. And that's why you see, again, in the public markets, if you look at all the RevPAR forecasts from the public companies who are forced to forecast, it's all deemed as very, very conservative. Of course it is, because nobody wants to go through the same situation as they went through last year where they're getting dinged, quarter over quarter.
So how's that changed your underwriting? I mean, and maybe, Cyril, let me ask you, what do you think has happened with cap rates?
I think it's no secret that cap rates, I got to say, are probably out from 15 at 100, maybe 150 basis points.
Yep.
I think that's a fair. It depends on the asset, obviously, the market. But I think when we're underwriting today, I'd say that what's different today than before is there has to be a very clear story to a lot of cash flow, and I say a lot of cash flow because I think that is your greatest hedge to a recession. Meaning, if a recession comes, everyone asks, when's a recession coming, or when's the cycle going to end, and you don't know. And I'd say you could say it's coming in, 2 years or 3 years, whatever your number is, but you can't invest that way, especially if you're a fund like us. You can't just assume that a recession is going to come in 2 years, because then you wouldn't buy anything and you would just wait 2 years. And you can't run a business that way. So your greatest hedge, I think, the way we think about it, is to buy a lot of cash flow. And in the event that there is a market downturn, I think cash flow will help you get through that, where you're not really tight on coverage, you're not really over-levered, and you're able to still wait for the recovery in 5 or 6 years.
So how's the cash flow been last year?
What do you mean?
RevPAR, but on the assets you've owned, have they been cash flowing very nicely, thank you?
Yeah, I mean, I think that's been a big strategy of ours, is to buy in-place cash flow and to change either the manager or do the CapEx that we think positions the asset the best way. And I think we've executed on our strategy and had 2016 was actually pretty good for our assets.
So just one thing to add, you said 150 basis points from 2015. That's not only 150 basis points, it's in-place cash flow versus forward cash flow.
Yeah, that's a great point.
Right?
It's really hard to underwrite forward cash flow today. You just underwrite in place. And I think you let the upside take care of itself.
So you could argue it's 150
more.
basis points, right? But it's maybe even closer to 200 basis points, when you factor that it's on in place versus forward.
I would also say...
Mitt must be trying to buy something.
No, I mean, look, do you agree? No, do you agree? I mean, just, again, we were all buying, let's just state the obvious, we were selling hotels at 7 caps in 2015, right? And they were on forward cash flow, so maybe it was like a 7.5, on existing, and it's 7 kind of on, and 8 on forward, or 7 on existing, 7.5, 8 on forward, and the like. So those kind of metrics. Well, that changed. I mean, and
completely.
We're sellers, right? And we're all buyers and we're all sellers at various points in time. Yeah. It's changed.
I would also say that the market is just so illiquid right now. It feels very illiquid. I would say when we're expecting for an asset that we would have expected 30 or 40 bids that we're selling, not 30, 40 bids, 30 or 40 CAs and maybe 8 to 10 bids, we're getting 30 to 40 CAs still, but 2 to 3 bids. It just feels very thin in a lot of what typically you would think would have gone in more of a liquid fashion. It feels very kind of slow.
So I think these are some of the short-term headwinds, but I think these guys are Debbie Downers here. I think Cyril must be in the market to buy something right now too. I think the macro trends, to Cyril's point about recession-proof, are more people are traveling every day in 2017 than they have in years. The macro statistics support that in terms of air travel and just frequency of travel. I ascribe most of that to the discount carriers, and each year another ultra low-cost carrier, a ULCC, pops up, and all those carriers that are flying people around for $39, and granted you get no service in your knees or on your chin, and it's a horrible experience, but for $39, what do you want? You can go to Florida and then you can stay in a Spring Hill Suites for $89, and that's a terrific vacation. So you're seeing more people travel, and I think the select service hotel model, which the three of us participate in quite heavily, is the way to play the recession. You know, if a recession does come in 2 to 3 years, our cash flows are going to be more stable than the cash flow of the building that we're sitting in. I think it's the nature of a 2,000-room hotel versus a 100-room hotel, and the nature of a suburban or secondary market versus a major CBD
By the
market.
way, this hotel did incredibly during the recession. It was actually up in 09 in NOI, which is
What?
incredible.
Wow.
Yeah, I couldn't believe it. But this hotel was up in NOI in 2009.
So, but anyway, Tyler, to your point, I think 100% agreement, I know, between the three of us, and I can imagine in the crowd. And actually, it's interesting, one of the analysts in our business, R.W. Baird, they actually ran this analysis in saying that if, select service extended stay hotels are an 8 cap, and industrial is at a, 5.5-ish cap, and retail's at, at a 5, and multifamily's at a 4. From a risk-adjusted standpoint, you can withstand a 10% decrease in RevPAR and select service, and still be at a better kind of yield relative to kind of all those other property types. So I think that proves the point. The issue, at least I think we're facing, both on specifically on the sell side, is really this dilemma about our forward cash flows better than in-place cash flows, right? And if so, then I think most people are buying kind of at a forward 8, and an in-place 7 or 7.5. So is that really an in-place 8 and kind of a forward 8 in today's kind of environment? That's the unknown.
Well, I think to answer that question, you really just got to look at new supply.
Right.
And the new supply in the U.S., I mean, the curve is just going up quite significantly right now. There are 112 hotels under construction in the Dallas market right now. Now listen, Dallas is a great city, and Toyota is moving there, and State Farm is moving there, but it's not that good. I am fond of saying, the most overbuilt market in the United States? Bentonville, Arkansas. It fills on Monday to Wednesday. We own a hotel there. Performance is terrible. And it fills on Monday to Wednesday because of Walmart sales trips, and then it doesn't fill the rest of the week. But you can see the investment thesis and the investment memo going through committee, being passed around amongst a bunch of golfers or a bunch of dentists, and saying, oh, Bentonville, that's where Walmart's headquarters is. We should build a hotel there. There's a flag available, or we'll go to the city next door in Rogers. So you look at supply characteristics of these markets. 50% of the new supply in the United States right now is in 4 markets: Manhattan, Miami, Austin, and Nashville. So if you go outside of those markets, you have a fighting chance at looking at the forward NOI and being successful. I think if you are building in Nashville right now, I couldn't get comfortable with the forward underwriting in Nashville because the new supply picture is, I don't know how long it's going to take to absorb.
For the record, we're not building Nashville, but the RevPAR just keeps going up.
I know it does.
It's unbelievable.
I know
it's
it
funny.
does. I can't reconcile
Say the same
that.
thing. You could say the same thing about Austin until I just saw that maybe I shouldn't name properties, but whatever. The W in Austin has dropped $20 in RevPAR the last 2 years, and it's forecasted to go down. I could not believe that. Austin has been one of the greatest markets, seems almost supply proof, and it gets you very scared about these super hot markets like Nashville and Austin when they're gonna, when you hit the saturation point on supply.
So where are you going? What markets do you like then?
I kind of like Atlanta right now. I'm not playing to the home crowd. I actually really do like Atlanta right now. We just bought the Meridian Atlanta. I think it's but there's got to be a story still. I think whether it's a market that we like or not. We just thought that there's some changes we could make there where we could dramatically improve cash flow. But I think there still has to be a story. We wouldn't just be a price, kind of just buy an asset let's say it's with no capex that's already been PIP'd, that has a long-term management agreement with the brand, where we would just buy and ride a market. I don't think there's a market right now in the U.S. we would just buy and ride.
Mitt, comments on Atlanta?
Well, look, Atlanta, I think historically, for those of us that live here, it's been the darling of the investment community, and then it's been like we're not touching it, and so we're kind of at a stage now where there's lots of interest in Atlanta from an investment standpoint across all real estate classes. And what I would say is that what's interesting about Atlanta is that it's kind of this population of individual markets. Buckhead's very different than Midtown. Midtown's very different than downtown in terms of demand generators. It's very different than Perimeter and where Cyril's at, and it's different than what's going on in Alpharetta and other parts. So I still view that while Atlanta is kind of capturing the whole, you have to look at the submarkets as every other market that we're all looking at, because it's not enough to just kind of look at just what's happening there. It's just kind of the individual submarkets, and there's some that we prefer well over others.
So it's not macro. I get it. Tyler, you agree?
No, I'll take the other side of that equation.
Figured.
Now who's a Debbie Downer?
Figured.
My two least favorite hotel markets in the United States of America are Atlanta and Chicago.
What about Dallas?
No, Dallas is amazing. Now, Chicago and Atlanta have never had the ADR. In every time we've studied them, we've never been able to get there. Listen, Mitt knows a lot more about Atlanta than I will ever know, and he's building here, so I'm sure it's the right thing to do. But, there's very few barriers to entry. It's a hotel-centric community. There's a lot of new supply popping up in Atlanta all the time. And, I know Delta and Coke, and there's a lot of drivers here that are growing it, but it still has taxes. So give me Florida or Texas over Illinois, high-tax state, or Georgia, all things being equal.
Are you guys developing, Tyler?
We are. We're building 2 hotels in Florida right now, one on Long Island, and a couple others. So we're building a Residence Inn right now on I-95 in Fort Lauderdale. It's about $185,000, $190,000 a door. The one constant in our business that I think we'd all agree on is construction costs keep going up.
And Residence Inns always overperform.
Yes.
Residence Inns always outperform. Residence Inn and Hampton, they're in the pantheon.
What do you expect your return on cost to be on the Residence Inn?
11.5.
Holy what?
I caught
This is not
myself.
sensitive.
I
It's on
promised
tape
you I
delay.
wasn't going to. I caught myself.
A Residence Inn is a prototype Residence Inn for $185,000 a key. Right? It's not cheap. When I first got into the business, I remember very distinctly going to a meeting with Cyril's partner, my old boss, and he said, $100,000 a key in Fisherman's Wharf in San Francisco? That's insane. That is a crazy number, and that was 20 years ago. And then fast forward to 2007, people said $150,000 a key. There was a psychological ceiling at $150,000 a key. Now I think the psychological ceiling is $200,000 a key, because construction costs keep going up, labor and materials keep going up, and that's not going to change. So that's what we have going for us in this business is construction costs keep going up, so the barriers to entry get incrementally higher each year.
Mitt, chime in. You built an AC in Buckhead. You just announced AC Moxie in Midtown Atlanta.
So we delivered the AC in Buckhead. It was our second AC in August of last year. We did it in a joint venture with Simon Centers that we're doing a handful of those around the country. We built a hotel in Nordstrom's parking lot, and we delivered it, and it is the right location, the right brand, at the right time. It's the first hotel delivered in Buckhead since 2008.
It's a beautiful hotel, by the way.
Thank
Congratulations.
you. I appreciate that. And we actually believe, when we build hotels, we've got about $500 million under construction right now. We always try and think about, we either kind of buy and fix and sell in 5 years, or we build it and try to create an income stream and then sell it. And for our new development and even our repositionings, we kind of wanted in the middle of that 5-year period to have a double-digit unlevered yield, and that will beat that thesis. And again, I think it's a combination of the right time relative to the cost of construction, the right location, and the brand fit, kind of what that market was doing. Midtown, we're under construction with the first dual-branded lifestyle Marriott hotel that they've ever done, an AC and a Moxie. We opened up a Moxie in New Orleans last year. And we're in between the Four Seasons and the Marriott Suites, from a location standpoint in Midtown. So I think one of the best pieces of real estate, Moxie will open on 13th Street and the AC on 14th Street. And that will be in at a price per room that is less than the Hyatt that we sold 2 years ago to RLJ. So from a replacement cost and kind of metric, so arguably equal to better location and a cost basis that has been proven up. The Renaissance sold around the corner for a much higher than our basis. So it's really kind of strategic. And that one we bought from a parking company that has a surface lot that wasn't making any money as a surface lot, and we basically repurposed and gave them spaces in a deck that we'll build alongside of that. So I think from development, we're building 2 hotels in Seattle at South Lake Union at Amazon's headquarters, same kind of scenario there. But Tyler's right. I mean, it's really, really hard to find this. Maybe a little devil's advocate. While we compete in markets where we're buying hotels with new supply, the new supply that we're creating, we feel like they're in locations that give us that real buffer. Like, I can actually make a case to go out and build 10 Residence Inns or 10 Home2 Suites or in these secondary markets and cash flow day one, a double-digit unlevered yield, right? But there's, we're a series of institutional funds, and it just doesn't fit with our model. But like, if we were owner-operators, we would. That seems like a pretty good business model in which to go get done. So the development we're doing is really, really hard and complicated, and hopefully we get paid for that based on the difficulty of and the product that comes out.
I think I agree. Tyler, do you agree? And I might add into that, here's your 30-second. I know you're doing an amazing project, JFK Airport. Mm-hmm. In case you guys don't know, Tyler's won the bid. He's building a hotel at the TWA, the old TWA terminal at JFK Airport. Amazing project.
Well, and I think that speaks to Mitt's point of describing like gymnastics or diving, the degree of difficulty scale. Nadia Comaneci, the higher degree of difficulty, the greater the barrier to entry, the more it keeps people out of this. And that's what Mitt is doing. That's what we're doing at the TWA project at Kennedy Airport. We're dealing with 22 government agencies. We have 124 consulting firms working on this project. It's a $265 million project, not including the power plant that we're building because we're going to be completely off-grid. It's in a historic building. We're going to have a 200,000 square foot lobby, 8 restaurants, 6 bars, 4 retailers, a rooftop pool deck. It's not for the faint of heart, but that's also what keeps other people out of the business.
Tell them what you were spending on a monthly basis before you actually broke ground.
We spent a little over $5 million in chase costs to pursue this project. We have 9 law firms working on the project. We sit on a double ground lease from the Port Authority and the City of New York. And we had to go through a ULURP process with 3 different community boards. And this is just the tip of the iceberg. But it's a ton of fun, and it's going to be a spectacular.
Yeah, good luck. That's awesome. I meant that sincerely.
God. Sincerity is Cyril's strong suit.
Yeah, thanks. Great.
All right, so I'm going to change. Cyril, I'm coming to you now. I want to talk. So I joked these guys that they weren't doing anything in 2016, right? But Cyril, I will argue, was busy flying to China back and forth. Arguably the one guy to one of the big guys to actually make an exit, get gobbled up by the bigger fish. Sold a $2 billion stake.
So yeah, it was 280 hotels. It was kind of the culmination of the strategy that we started. Starwood Capital wasn't really in select service hotels in the U.S. Really until we started buying them in 2011 and 12, and then obviously continuing through 15. It was actually a $3.4 billion total sale. There were 3 or 4 different LPs, mostly Asian, that came in to do an equity recapitalization. The entire process took, I think I was here last year, and I think I said on the stage that we'd be done in a few months, or a few weeks or a month, and we closed at the end of September. The entire process was about 15 months. and it required a lot of travel. And but I think it makes.
How many times did you go back and forth to China?
I think I went 5 times or 6 times. Met with a chairman every time. It was a different chairman, but it was a chairman. But it was, when we talked to our Asian partners, I think they found what I think a lot of us in this room have known for a long time, that if you want stable cash flow in the United States, you want to buy the United States economy and you want stable cash flow in the real estate and the hotel world, you can certainly get a lot of safety buying the jewels or the trophies in New York City. But if you wanted the stable cash flow, you get it in select service hotels. And I think that the yield that we were offering and that this large portfolio was able to provide for them was incredibly attractive when they're looking at a world, at an entire world that has 1% interest rates, if you want, or even sub 1% interest rates.
How unique was that transaction?
I wouldn't say it was unique other than the asset class. I think it's been done many times with different Asian partners, Chinese life companies. You could see the Waldorf deal got done, before this one. When they
How much of that was what I will call the Barry factor, the Barry Sternlicht celebrity factor, that, hey, China Life, you want to invest with this guy?
That's hard to say. I think obviously Barry offers a name brand like Barry or Starwood Capital Group or a Blackstone or a name like that obviously offers some sort of security that you have a guy like Barry looking over, who's managing these assets for you. And they wouldn't have done this transaction without us staying in for a piece of it and staying on as the asset manager. So I think that is absolutely something that can't be overlooked, though I think that might be just for the first one. I think that in our subsequent conversations with many of our Asian capital partners, I think that they will continue to look for superior cash yields. And I think there will be more transactions like this one.
How much are they looking for yield versus simply a return of capital? How much of it is a currency chase? Let me just get the money out.
It felt a lot, at least from some of our Chinese partners, that they wanted to buy dollars. They just wanted dollar-denominated currency, and so I think that is, again, that can't be overlooked. But this was more they wanted the yield, because if they really just wanted to convert into dollars, they would have bought the safest office building, in New York City and paid the 3 cap or whatever it was, and felt really good that they were buying something for 20 or 25 years. I think this is different.
I would agree.
So I just want to add one thing. 2 things to pay note, because I think the majority of folks here focus in on this sector of the business, select service extended stay. So 2 things. Sureel just said, Starwood Capital really wasn't a player in the select service extended stay business until Sureel really led them down that path. And at a time where it wasn't completely obvious in $3.4 billion, that did significant positive, that added significant positive momentum, I think, to our space in terms of really creating an institutional environment. What Sureel did, what Blackstone did in terms of their significant investment in select service hotels, created a platform and a public understanding. If you look at the public hotels today, in today's environment, 2 of the highest trading EBITDA multiple companies are Apple and Summit, right? I mean, well over Host, well over others, and it's the feeling that this is a resilient, durable investment class. So not only did you take the leap of faith and do something that you thought was in the best interest of Starwood Capital, to realize that on the back end, which I don't know all the investments of Starwood Capital, but my guess is that's going to be a major value driver for the entire fund. It also, I think, for our industry, and specifically select service and extended stay. Go back to the R.W. Baird conversation that we had. I think that's really positive for the select service and extended stay. I've heard people say that you can't really even look at the lodging industry in aggregate anymore. You almost have to pull this part of the industry out and treat it as something that's very unique and different from the rest of lodging.
Which I would argue we've always known.
And my hat's off to Sureel as well. I think it was the deal of the decade. It was a terrific transaction, particularly in 2016, in a dearth of, in a wasteland of transactions. And I think one of the reasons why 2016 was so slow is because the yield buyers were largely not there. They were there in 2015, and then a lot of them left the market in 2016. So Surreal managed to find a high-quality yield buyer. People have been paying for yield, and I think will always continue to pay for yield.
Great.
To Mitt's point, there's a 600 basis point spread between what you can buy a select service hotel at and the 10-year Treasury. And that 600 basis point spread goes up and down over time, but it stays at roughly 600 basis points. So it's a more volatile cash flow stream for sure than the 10-year Treasury, but that could change with the current administration. But I think what you saw is the non-traded REITs in 2016 largely left the market.
Yep.
Traditionally, they raised from the retail space $20 billion annually, and in 2016 they raised $5 billion. So the absence of the non-traded REIT sector of the marketplace took a big chunk out of the yield buyer and contributed to a lot lower asset sales. So good thing for everybody in the room and us up here is the non-traded REIT sector has come back, and there's a new $5 billion fund in the market that has broken escrow. There's a lot of new non-traded REIT money that is a yield buyer. That's a perfect consumer of the products that the marketplace that we're transacting in.
It's amazing to see how select service has transformed over the past decade. And you have every single, I guess with this transaction that just happened, you have every single buyer now owning what was once a pretty fragmented industry. It's fantastic for our industry, I think.
I totally agree. So let's go forward. What's 2017 going to look like? Let me frame it a little bit in the capital, right? I can tell you, I feel there's more and more capital showing up today than there was even 3 months ago, certainly 12 months ago. Right now, my framing is there's far more capital than there is product on the market. But talk whether it's transactions or revenue, what have you. Mitt, how do you see?
Well, I still think if you look at kind of the data that's coming through, it really is market by market. I mean, there's markets that are showing double-digit RevPAR decreases, and there's markets that are showing double-digit RevPAR increases, kind of on board. And I'm not talking about the top 5, 10 MSAs. I get the feeling like where we're starting to stabilize a little bit in the oil markets. I mean, Tyler, you've got got a lot of presence there as well. I think that bodes well for the kind of the broader industry and just kind of on the operating metrics. Competitive wage inflation is real. I think we're all seeing it kind of in our hotels. The costs, the old adage is that, you kind of, you add a dollar in RevPAR, you should add, some percentage of that in NOI. I think some of those pressures continue to become more real and real, both on the upside and then potentially on the downside. But we're still very, very positive on kind of overall RevPAR for the industry for this year. And we're not public, so I think we can say that I think we're at the top range of what most public companies have projected in terms of what we think RevPAR is, and that's kind of absent any black swan event. I do believe the investment in infrastructure spending and some pro-business legislation will continue to have a stabilizing effect, and I didn't necessarily feel that way. In times past. So I think that kind of adds a little bit of benefit. In terms of the deal flow and deal volume, I still believe that we need to see some sort of clarity that happens in the marketplace before there is enough sellers that are out there that really kind of have to kind of do something. I will say these thousands of CMBS loans that were originated in 06 and 07 will have to get dealt with in a CMBS market that is bumpy to say the least. I believe that construction costs increasing as they are with the amount of construction lenders that are exiting the marketplace is creating some, I think, unique situations for developers and owner-operators in terms of how to finance that. And I also believe that there is a significant amount of next-generation leaders and hospitality leaders that are out there that are looking to kind of say, all right, how do we forge our own path? All of those kind of converging together, I'm fairly optimistic that there's going to be more deal volume towards the middle to the end of this year than there is today.
I agree.
So, I think you're going to see, and you've been seeing this for 5 years, and you're going to continue to see this, if you're a global sovereign wealth fund or a institutional money manager, and you look at the planet, where's the best place to put your money? I think it's still the United States.
Select service hotels.
Select service hotels.
In the United
Good
States.
idea, Stella. No, but I think the U.S. is seeing a flood of capital coming in. Europe has had anemic growth for 5 years. They're still dealing with the aftermath of Brexit. Now they're talking about Frexit. If the Scotland people vote to leave the UK, that could further hurt the UK. They'll lose the North Sea. South America is back to its old tricks again. Hyperinflation, disastrous economies, can't keep politicians in the seat. China keeps decreasing its growth. It was supposed to be at 6.5% this year. It ended up about 6.2. Japan has been the same for 25 years. Where are you going to put your money to get growth? And so I think, German investors are seeing this. Sovereign wealth funds are seeing this. They're coming to the U.S. Across all asset classes. And I think the good thing is most people are upping their real estate allocation.
Yeah.
Real estate allocations were traditionally around 7 to 9% of big institutional capital pools. Now they're getting up to 10, 11, 12%. And most of that is coming at the expense of hedge funds. Hedge funds are just getting annihilated because they can't generate alpha. And they haven't been able to for a very long time. And as the world becomes even more and more commoditized in terms of information, there's actually alpha in hotels because they're very hard to run. You can't just walk up to a hotel like you can an office building and collect rents. It's a branded business, it's a real estate business, it's a finance business, it's an operating business. It's complicated. And it's a lot harder to underwrite a hotel. And I think that natural barrier to entry is going to keep the spread over treasuries quite high. I think the Fed's going to tighten a couple more times this year. And I think that's fine. So if the Fed tightens by another 50 or 75 basis points, I think that's, and RevPAR grows 2 to 3%, and labor costs grow at 2%, but labor is 25% of your economics. I call that a big win for the business.
What do you think happens to cap rates if the Fed increases rates 75 basis points?
I think cap rates are driven by the money flow on the demand side of the equation. It depends how many people want to buy assets this year. And how many people want to buy assets this year is largely driven by the debt markets. So if the CMBS guys really start backing up the truck and you start seeing covenant-light loans again, like you did in 2006, 2007, I think that will really put a turbo boost on the transaction market. But even if that doesn't happen, we were with Bank of America the other day. They have a $68 billion loan book, and they are anticipating in their internal models that they're going to get paid off 25% of their loan book. So that means they got to put $17 billion of new loans out this year. They got to originate $17 billion of new loans. I think that's good for the business.
You think deregulation helps?
Yeah, I think Dodd-Frank was terrific. The banks are lending as they should be. They're lending to good credits on good assets. You're not seeing sloshing around of capital in the construction markets. And I think it really worked. The bank balance sheets are wildly healthy. Deposits keep going up, and they're still not paying, passbook account holders anything in interest. So if they can put the money out, they make a nice spread on the capital. And I think consumers stay pretty healthy because they don't have a lot of bad loans on their books.
Cyril, what's the state of our industry right now, as you see it?
The state of our industry?
Yeah.
I think we had 40 minutes on that.
No,
we
we just
have
did
a
5.
minute and a half left.
Let me do another one. What are we talking about this time next year?
Oh, that's a good question. What are we talking about at this time next year?
Trying to give you a softball.
I think the question you originally stated was on capital. From Starwood Capital's standpoint, we are in the midst of raising our 11th fund. It'll be likely the same size as our last fund. Our 10th fund was $5.5 billion. And I think buyers like Starwood Capital and other private equity funds with the capital are going to have to get aggressive. And I think you're going to see, I think we're going to be talking about some significant acquisition over $2 to $3 billion that was done by private capital in the next 12 months. I think that's what we're talking about, the mega deal that happened.
That'd be great. Mitt, last word. What are we talking about next year?
I think we're going to be talking about this year, for many, wasn't as good as we thought, and wasn't as bad as we thought, right? And I think that's probably the case of last
Never is,
year,
right?
Never is. And that's why I believe that just kind of sticking to your knitting, these guys said that. This is a great business. We've seen it all over, over time. We've been here 23 years, and ruble collapse of '98 and the dot-com bust of 2000 and the incredible tragedy of 9/11, the Great Recession. And I think the right hotels with the right brand, the right markets is all what we try and do. But when you do that, the cash flows are resilient. And so it's never as really good as you think it is, and never as bad. And I think kind of just staying to your knitting, we'll all recognize that's still the case.
It's a good business.
Yeah.
I think we're all participating in a great ecosystem that is going to last for a long time. And, I think next year we're going to be talking about how it's the 10th inning, but we're playing an 18-inning game.
Yeah. I think we'll still be talking about the Atlanta Falcons collapse in the Super Bowl, though. I didn't like it either.
And we're out. It's a great business. You guys are fantastic. Thank you, everybody, for coming.
Thank you.